Hello, I am Sriram Ramanathan, CIO Fixed Income at HSBC Asset Management India. Over the next few minutes, I'll be giving a brief overview of the recent events which have influenced our bond markets and also touch upon an investment opportunity which in our view is quite attractive. Starting with the global scenario. In our annual outlook, we had said 2023 would be a year of changing narratives. Into the first 2 months of the year, we are already seeing this play out quite dramatically, with the US 10-year yield rallying by almost 50 basis points from 3.88% on 1st of Jan to a low of 3.37 within the first few weeks of January, on market expectations of a dovish Fed, but then retracing all the way back to 395 by end February as the bond markets caught up with what the Fed had been saying in their dot plots all along, that is, higher for longer. We expect this global uncertainty to continue, with similar two-way swings to the rest of the year. At the same time, with the US bond markets now pricing a peak rate of 5.5% and barely one rate cut in the next 1 year, we believe bulk of the bond yield adjustment is now done. Hence, going forward, US bond markets may be less of a negative influence on our Indian bond markets in our view. Now shifting focus to the Indian markets. Interest rates over here too have been moving higher over the past few weeks, influenced firstly by the US Treasury moves, but also by tightening liquidity, typical of the Jan to March quarter, and importantly, by the most recent Monetary Policy Committee meeting and its minutes. Markets which were expecting a dovish tilt from the RBI have been clearly disappointed, with RBI reiterating continuation of its Arjuna's eye on inflation and its determination to see it sustainably lower. Now, this has resulted in yields moving higher by almost 50 to 60 basis points in the up to 1 year segment and by 35 to 40 basis points in the 3 to 4 year segment. The 10-year government security has moved relatively less by only about 15 basis points, leading to a very flat yield curve beyond 5 years. This upmove in interest rates, in our view, provides attractive opportunities for investors to take advantage of. Markets which were earlier pricing in a 6.5% peak repo rate and a possible pause thereafter have moved up sharply to now price in not just the next 25 basis point rate hike, which would take the repo rate to 6.75%, but also to a large extent the subsequent move to 7% as well. In our view, this adequately prices in the adverse risk scenario that the markets are now grappling with. To sum up, in our view, firstly, the next few years are likely to be good for fixed income investors, given that interest rates across the maturity spectrum are now well above 7%. Secondly, while markets will continue to assess growth versus inflation risks both globally and over here, we believe we are close to the peak of the rate hiking cycle, with risks of RBI having to hike rates above 7%, for example, being fairly low. And thirdly, importantly, in our view, the waiting game for fixed income investors is now over, with the risk reward turning in favor of careful deployment into certain areas which offer the best risk-adjusted returns. With this backdrop, where current market offers a good entry point for long-term investors in terms of risk reward, let me now turn to our upcoming new fund offering, the HSBC Gilt June 2027 Index Fund, which is opening on 6th March and closing on 20th March. A few key points of the fund. The fund is a passive fund with a buy and hold strategy, and it aims to replicate a predefined index. It will mature at a predefined date, that is 30th June 2027, and will only invest in securities with maturity lower than the index fund maturity date. Follows a roll-down strategy, which means that the interest rate risk will keep reducing over time and the underlying securities will mature prior to the index fund maturity date. And finally, it invests only in central government securities, which means minimal credit risks. Of course, it offers daily liquidity to investors like any other typical mutual fund. Finally, before I close, let me explain why we chose the Gilt June 2027 index for our fund. The 4 to 4.5 year part of the sovereign yield curve where this fund will invest in is attractively priced in our view, with the underlying central government securities yielding 7.44% semi-annual yield, which translates to almost 7.58% annualized yields as of most recent data. Yields are almost at the highest level seen over the past 4 years in this segment. Also, in this segment, state development loans, as SDLs as they are called, spreads over GSEC are at 20 to 25 basis points, which again in our view is quite unattractive from a risk-reward perspective. Hence, we have chosen to go with a predominantly 100% GSEC index for this NFO. And finally, investors with a holding period of greater than 3 years can claim long-term capital gains taxation applicable to debt funds, as this fund will offer up to 5 indexations. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.